Most businesses own assets that are used for several years. When a company acquires a vehicle or builds a plant, it is reasonable to expect that the asset will be part of its business operations for the next 5, 10, or 20 years. At the same time, it's clear that these assets won't be used indefinitely, as they will become old and obsolete. During each period, a portion of the cost of these assets is being used up. The portion being used up is called depreciation. The economic meaning of depreciation is that, year after year, the asset becomes older and loses some of its market value. Depreciation is shown as an expense in the income statement because the asset has been used by the business, and this is a cost that should be accounted for when calculating the company's profitability. Imagine that a firm buys a vehicle for $30,000. The vehicle has an estimated useful life of 8 years. How much should be charged as an expense this year? We know that $30,000 has been paid for the vehicle, but only a portion of this sum can be attributed to the current period, right? Instead, the following will occur. The firm will register an asset that costs $30,000 on its balance sheet and will decrease its cash by $30,000. Then, year after year, the value of the asset will decrease because it becomes older and obsolete. The firm will have to implement a depreciation method in order to calculate by how much the value of the asset will be reduced each year. Two main methods can be used to calculate depreciation: straight-line depreciation and depreciation based on use. The straight-line depreciation method does the following. It considers the initial cost of the asset and its salvage value, which is how much will the asset be worth at the end of its useful life. Let's say that, in our example, the salvage value of the asset will be $6,000. Then we will calculate the difference between $30,000 and $6,000, which would give us the amount that will be depreciated throughout the useful life of the asset. $30,000 minus $6,000 equals $24,000. Given that the asset will be used for 8 years and we will apportion the depreciation expense equally, we will have $24,000 divided by 8. So the annual depreciation calculated with the straight-line depreciation method will be $3,000. Very well. Now let's look at the activity-based method. The firm can estimate that the vehicle's useful life will be 200,000 miles and assign it a salvage value of $6,000. Right, so $30,000 minus $6,000 equals $24,000. Let's divide this number by the vehicle's useful life. We have $24,000 divided by 200,000 miles, which equals 12 cents per mile. If we hypothesize that at the end of the current year the vehicle will have 30,000 miles on its odometer, the company will have to use this number to obtain the depreciation expense that will be registered in the income statement. It will be equal to 30,000 miles multiplied by 0.12, which equals $3,600. By using this method, the company agrees to calculate the vehicle's depreciation according to the number of miles that it has been driven. We will have a similar picture for intangible assets. Assets such as software, brands, goodwill, and artistic assets are called intangible due to the fact that they are not physical in nature. The equivalent of depreciation for intangible assets is amortization. Depreciation is always used for tangible assets, while amortization is used for intangible assets. The two are almost always grouped together and commonly referred to as D&A. We should bear in mind that only intangible assets with finite lives, such as software licenses, are subject to amortization. Intangible assets such as a firm's brand are not amortized, given that they have an indefinite life. In this lesson, we learned more about depreciation and amortization, and their impact on tangible and intangible assets. Thanks for watching.